And I think for silver, it's likely to take us at minimum, I'm talking like sometime in next quarter, first quarter of next year, to 100. And if, on the other hand, in the first 3 months, don't be shocked if this happens, meaning of these, okay, if we get up near 100, then I think we're going to about 200. And
wow.
Well, no, it's not insane.
Because I mean, gold would be at, five, 6,000 at that point.
Gold might be 8,000 by then, but if silver were 2% of $8,000 gold, let's say gold does the routine again.
Yeah.
Okay.
Yeah.
2% of that's 160. Is that right? Yeah. Okay. Yeah. I mean, you get the point.
Silver has been following the same exhausting pattern for almost 50 years. It rises beyond $40, then falls, and then it spends years in a sideways grind. However, seasoned market watcher Michael Oliver believes that cycle is now ending. Oliver became positive on silver in 2016, immediately following the market's severe bear market bottom, using his own original momentum models. His indicators haven't gone negative since then. This indicates that silver has, in his opinion, been in a covert bull market for nearly 10 years. Oliver thinks we're about to enter what he refers to as the acceleration phase, which is when prices abruptly soar higher in a brief surge of momentum in every significant bull market. He predicts that if gold spikes to the $8,000 range, silver may reach $100 by the beginning of next year, with a possible run into $200. Although that may seem severe, technically speaking, it makes sense given that silver is only trading at 2% of the price of gold, which is well within historical norms. Be sure to like, subscribe, and hit the notification bell for more insights into gold, silver, and precious metals investing.
I'm already in, and our subscribers have been handheld for the last years. We got bullish in February of 2016, 2.5 months off the bear low.
Yeah.
Annual momentum of gold and silver said, it's over, I'm going back up. Nothing has changed the annual momentum of gold and silver, very long-term trend metric, okay? Mm-hmm. Nothing has altered that view. So it's been an ongoing bull for 10 years. And we're now at the point, I think, where the acceleration phase, the dramatic phase, where half the move occurs in 6 months, is about to occur. And I think for silver, it's likely to take us at minimum, I'm talking like sometime in next quarter, first quarter of next year, to 100. And if, on the other hand, in the first 3 months, don't be shocked if this happens, meaning of these, okay, if we get up near 100, then I think we're going to about 200. And
wow.
Well, no, it's not insane.
Because I mean, gold would be at 5,000, 6,000 at that point.
Gold might be 8,000 by then, but if silver were 2% of $8,000 gold, let's say gold does the routine again.
Yeah.
Okay.
Yeah.
2% of that's 160. Is that right? Yeah. Okay. Yeah. I mean, you get the point. But also, when you look at the silver chart, it's very important because that log scale gold chart, I've got this red arrow going up over the 5 decades. It's been wave after wave, but higher and higher and higher. Silver, you could draw a line sideways through 1979. And, we had 2 peaks at 50. We're only marginally out above that now. And so it's been caught in a 50-year range. We think this is a shift to a new reality and price level for silver, meaning when you move out of this zone we've been in for 50 years, okay, and you go to $100, $200, you're not coming back to 50. You're going to live in a new range. Yeah, there will be sell-offs in that range, but the level has got to be sought out first. And frankly, you can look at a monetary degradation issue, like you mentioned, the money supply increase. Well, if you compensate for that, we'd be $200 easily. Okay. But there's some other charts I've included too that sort of smack you in the face. The next set of charts that I sent is 3 simple, stupid commodities. Okay, these charts are all from the Federal Reserve of St. Louis, Fred. Okay, and one is the top chart is the price of lead. Okay, going back to the late 1980s. In fact, you could go back to 1980, and you'll see that the first phase of that price action is the arrow on the left at a very low level. It just goes for decades sideways. It sort of looks like silver today, where it was in 1980, okay? But look what happened to lead. It just suddenly went boom and quadrupled in price, not because of a crop failure. Okay, we're talking a base metal here. Now, wheat can explode because of a crop problem, but, a base metal doing this. And by the way, other metals did the same thing around that time. But it went to a new reality. And yes, then it dropped off again. But look at the new reality that's prevailed since then on the lead chart at a much higher level, horizontal for decades.
Yeah.
Silver's still in the first range. Okay. Then the second chart's copper and copper products, as the Fed calls it. They incorporate products of copper. Same story. Multi-decade range at a given level. Then suddenly within a matter of about 6 months, you move into a quantum, to a new level, and you go sideways again, but at a whole new reality of price. And now copper's at all-time new highs, above even the 2011 high, which silver has only just done. Okay. Mm-hmm. The bottom chart is beef. Okay, pound of beef. Okay? Oh. Look at what it's done since.
Don't get me started. Go to your butcher.
It goes up in layers, and then it jolts, and in a new reality. Silver's about to enter that new reality, and we know its fundamentals. We don't focus on that, but we know that they've been tight for years. They get tighter. Industrial demand is continuing to rise because of solar, and the solar cell stuff. And also AI is creating a lot of demand because silver in micro forms is used throughout the whole system. And yet supply is not increasing. In fact, silver has a unique attribute in that most of the silver that's mined does not come from silver miners who are motivated, of course, by a rising price of silver. They come from people that mine magnesium or lead or zinc or copper. So it might be a marginal issue for them to increase silver production because, frankly, it's just a byproduct of their copper production, et cetera. So they're not motivated by rising prices. Silver has a unique fundamental game. The question is, when is it going to do it? We think it's begun.
According to Michael Oliver, gold is clearly headed for at least $8,500 and perhaps much more. He has discovered a significant trend when examining the history of gold after private ownership was once again permitted in 1975. Two significant bull markets that are almost the same in size but differ in duration. From its bear market bottom to its peak, gold rose roughly 8 times in both situations. Furthermore, Oliver contends that the rally may easily surpass those forecasts given the current climate of record debt, economic instability, and unrelenting money creation. Although he is very optimistic about gold, his true focus is on silver. In the past, silver generally outpaces gold by a significant margin in the early phases of a gold bull market before exploding higher as momentum builds. Now it seems like that trend is coming back. Now, let's get back and hear his following words.
Let's start with gold. Obviously, it's just on a rip every day, new all-time high. Where do you see it going?
Well, I'm not sure where it's going, but I suspect there's one level it'll at least see, and that's 8,500 area on gold. Now, there's a couple of charts I sent you. Mm-hmm. And the first chart shows a logarithmic scale, a ratio scale chart of gold going back to 2015, 1975, excuse me, when the federal government allowed us to own gold again. Okay.
Yeah.
That was very nice of them. Anyway, we've had 2 major bull markets in that 50-year span with external conditions that are nowhere near the dynamite conditions we've got in terms of factors that could drive gold. Both were 8-fold moves in price, from bear low to bull high. No matter what the price, the different duration trends. One was about 3 years, one was at 10. Okay, but the moves were the same, 8-fold. Our bear market low, last one was $1,046, $1,050 in 2015. Okay, we're only halfway the dimension of the upside of those 2 prior bull moves. You can see it on the log scale chart at the top, which is the gold chart. If we were to match those 2 moves, just don't say we're going to do it again, okay, good, 8,000 plus gold. Okay, now that's just compared to the old bull market peaks. Now, it may not stop there because these factors we're talking about are horrendous, especially government debt, not just here, but Japan, elsewhere. Yeah. That game is yet to explode in terms of its real world consequences. Mm-hmm. My own personal assessment and portfolio is emphasis on silver now. Okay. Silver moves with gold, but it sometimes lags, sometimes outperforms. Usually it lags. Okay. Now, this year it hasn't. It's actually up more year to date than gold is. Okay. Mm-hmm. By a couple digits. Okay. So it's significant this year. But historically, it's still very low relative to gold. Like silver's trading at 1.125% the price of gold right now.
Mm-hmm. We 80 to 1? Is it still 70
we don't do it that way. We divide an ounce of silver into an ounce of gold, express it as a percent. And if you go back over that 50-year span of time, we don't show it here, but silver in 21 of those 50 years that we've had has at least been 2% of the price of an ounce of gold. minimum. And in bull trends, like 79 to 80, or we're in a bull trend now, right? Okay. Yeah. Or in 2010 and 11, silver was 3% or more the price of gold. So right now at 1.125, silver is very cheap relative to gold. But it's technicals of that spread relationship. And we study it, the week by week, month by month, and we run momentum of the spread. Momentum is now breaking out. It's telling us the spread itself that is rising, favoring silver since the beginning of the year, or especially since April, since April, sharply. It still hasn't broken out on the spread, but the spread, you get above 1.31% to get bean counting for you. Yeah. And we're headed toward that level. You're going to blow out like a 3-year high on the spread, in which case you're going to rush. Why is that important? That is the prominent indicator back in the 1979 to 80 surge, this final 6 months of that move. Silver had already been going up for years, so had gold. But suddenly in summer of 1979, that spread broke out of a situation it looks just like now. In other words, a potential breakout level, silver versus gold. It's at that point that the net price of silver, not just its relative performance, went boom off the page. I mean, it left gold behind. Gold was still rising, okay, but silver just went whoosh, okay. Exact same thing happened 2010. Like in September of 2010, silver had already been rising for years, so had gold. The spread broke out again. Said silver's, I'm back, okay. And by April of 2011, silver had gone from $28 to 50. From that point, we're at that cusp right now, where if you go through that level that I just mentioned, and 1. We're nearing, 1.31, you get above that, there's a vacuum between you and 2%. And that's not necessarily resistance. That's just a level we've been at 20 of the past 50 years, okay? So it's hardly exciting to get there.
Michael Oliver makes a compelling case for why the long-term bull markets for both gold and silver are about to enter what may be the most explosive phase of their histories. He starts by examining the past. Since the United States legalized gold ownership once more in 1975, there have been 2 significant bull markets in gold, with each one seeing an 8-fold increase from its lowest to its highest price. The second took place between 2001 and 2011, whereas the first took place in the latter part of the 70s. He clarifies that the current state of affairs, which includes unprecedented levels of global debt, unmanageable government deficits, and decades of unrelenting currency devaluation, is significantly more severe than previous bull markets. When the effects of unmanageable debt eventually materialize, these dynamite conditions, as he refers to them, might propel gold considerably above historical estimates. The silver to gold ratio, an important momentum indicator, is currently poised to break out, according to Oliver's technical models. He claims that if it rises over about 1.3%, it might cause the same kind of spectacular spike that occurred in 1979 and 2010 when silver unexpectedly outperformed gold. At that time, silver prices doubled from about $28 to $50 in a matter of months after the ratio breached higher. According to him, we are once more at the cusp point. Years of silent accumulation, a tighter spread, and now the first indications of momentum moving abruptly in silver's favor make up the setup, which is almost exactly the same. If you enjoyed this video, don't forget to hit the like button, subscribe to our channel, and turn on notifications so you're always up to date. Thanks for watching.